So I was asked to address this topic again with regard to what's going to happen with the stock market in 2018. Evidently, there's a lot of talk about the stock market potentially crashing in 2018. And although I think that in 2018 a crash of the stock market is highly unlikely, that there is foreseeable possibility to have correction or sector rotations in the stock market. And I think the question was a genuine one. It was from one of my subscribers, and the question was, how do we as new investors deal with the swings in the market? How can we prepare for an eventual, downturn or a correction in the stock market? And it was a really good question. It was from one of my best subscribers, actually. We'll call them Rolex to protect their anonymity. They know who they are. So this video is going to be talking about how you can kind of prepare for investing in 2018 and kind of give you guys some of my perspectives on why we prepare so aggressively now to prepare for any foreseeable condition that the market can provide for us. It could go down, it could continue to go up, right? Nobody can project where the market goes. But I think for a lot of new investors, I think we kind of invest and we get vested and we hope. And then when we get that 10% correction, we act on emotion and boom, we're out. All right? So the first thing that you guys have to understand is what is investing, all right? I know for a fact that I put a lot of information out there, and I expect that everybody hear my message and understand that investing can be for anybody. It can be for anybody. I know that there's investors out there who don't know a thing about the stock market, who will do exactly what I say, get a self-directed account started, and be successful investors. On the other side of the coin, there's investors out there who think they know it all, and they will actually be the ones that fail in the stock market. So I don't discriminate in my message between, talking and saying that only 20-year-olds can be successful in the stock market and someone in their 50s or 60s or 70s cannot. I don't believe that. I don't believe that in the least bit. As a matter of fact, I think a lot of the younger crowd takes some of the things that are available to them now in today's society with the level of access and technology and the accounts that are available in the investing world somewhat for granted. I think the folks that have worked and earned their right to participate in the stock market, I absolutely give you my stamp of endorsement to do that. And we're going to be coming out with a series here that's going to be talking about 3 options in investing. It's going to be option A, B, and C. And it's going to break down your category based on 3 different aspects. It's going to be based on your age, your risk tolerance, and your investment capital. Those 3 things are going to allow me to put you into a model portfolio, and I'm going to be working very hard for you guys to kind of look at a portfolio template and pick from a basket of investment assets that I have researched and spent a ton of time researching behind the scenes for you guys to make it so much more easier to pick your category, pick your basket of stocks that I'm going to be picking for you. It will be flexible, but at least it's going to help you guys kind of take a blank palette or a blank landscape and start to define what processes are going to work for you guys. Guys, if this is your first time tuning into the Independent Investor channel, I highly encourage you to subscribe to the channel. We're filming from New York City, New York. My name is Ryan. We're going to be talking about how new investors can approach the stock market in 2018. And we need to talk about what is investing, okay? When you start investing, a lot of you guys just don't understand. You hear, about everybody making money and, oh my God, I got to get involved. And it really doesn't resonate with you as to why you want to get involved. And sometimes we get kind of bullied into the stock market a little bit. But you have to understand that investing it's a commitment, okay? And it's a commitment to really more mental than physical, okay? A lot of us out there have some investment capital to put toward the investment. But when I look back over my investment career, some of the best milestones that I passed and succeeded in the success in my investing career were weathering downturns. It wasn't a 30-minute stock trade of Amazon to make $1,200. That wasn't one of my successful moments. One of my most successful moments was back in the downturn of 2009, 2010, when the stock market really got hit, and I was a beginning portfolio holder in a new brokerage house, and I got to watch my new assets adjust back $6,500. And could I have panicked and ran? Yes. A lot of people will do that, and I put out this message full well knowing that there are potential in people who don't think there's potential, and there's also folks that they talk a big game and they're the big bad investor, and the first sign of a shadow on this market, they're going to run for the hills. I know that for a fact, but I still deliver this message openly to anybody who wants to hear it and understand that it takes a little bit more to understanding what is investing. And you have to take the goods with the bads. You are going to have some appreciation, all right? You are going to be paid dividends if you enter stock. You are going to have some capital appreciation, but you are also going to have some capital depreciation. You are going to have market swings. The stock market is going to swing up and it's going to correct down. This year was an anomaly because we didn't have a correction any more than 3% throughout the whole year. So my fear is a lot of people have been kind of lulled to sleep a little bit in thinking that this is the norm. It is not the norm. 2017, if anybody got involved in the stock market, you could have thrown a dart at a dartboard and made money, okay? It's that simple. And I don't mean to impugn the stock market from 2017, but it was a piece of cake. It was a cakewalk. Any stock out there could have, we got stocks going up right now, Riot Blockchain. If it has blockchain in the name of the technology, the stock goes up, 500%, and the companies are worth nothing, all right? That's what's going on here in 2017. Once we start to get into a little bit more normal rotation, and this tax bill that just got passed is going to have to stand on its own in 2018, I expect that some volatility is going to come back in the stock market. And what does that mean for us as new investors? All right. Key number one to help you guys in approaching the stock market and not losing sleep overnight, okay? I've been doing this an awful long time, and it's hard for me sometimes to retract and really kind of sit back and say, what is it that you guys need to posture up? To defense up a little bit, right? To address the, gosh, Ryan, I'm scared, man. I've got my nest egg. I've got my first 5,000 saved, and I want to enter the stock market, but I don't want to lose either. You know what I mean? And that's a fair question. And the way I approach it with my first aspect is to layer up. All right, to layer up. I have 6 accounts. All right, 6. All right, checking and savings, brokerage, 2 retirement accounts, and then the 529s for the kids too. But I've got 6 accounts, and each one of those accounts kind of work independently to help me layer up. Oh, excuse me, and I have my retirement account. All right, so that's actually 7 accounts to help me identify different pieces of the market. Now, each one of those segments, like my thrift savings plan, which is on par with your guys's 401ks, your 403bs, your 457 plans, anybody out there who has a employee-sponsored retirement account has that nice baseline already started, and that passive baseline should be just that. You shouldn't touch it, ever, ever. So put that aside and stop worrying about it. Now, if you have that 401k or that employee-sponsored retirement in place, that can really speak to how we build out the self-directed Roth IRA account, whether it be 1 or it be 2 accounts. It can definitely complement how we may populate a brokerage account, okay? But we have to go through these stages and identify how many layers that we have. Now, for you beginning investors, it could very well be a checking, a savings, a brokerage, and a retirement account. Those could be your 4 layers, okay? But you have to utilize all 4 layers to help in defense of a potential market correction, sector rotation, things that are inevitable in the stock market. We just don't know when they're going to be, okay? And that's why I talk all the time. I've got hit with a lot of questions of, Ryan, you've got too much cash on the side. Ryan, you've got too little cash on the side. Ryan, you've got too much bond exposure. Ryan, you've got too little bond exposure. The reason why I recommend having those cash reserves in place is because of that layered philosophy. I see way too many people save their first $1,000 and they want to go drop that $1,000 on AMD or GoPro. It's the wrong way to approach investing. I'd rather have you take that $1,000 and put it in the savings account. I really would. And fund a retirement account going forward, okay? That's what I'd rather have you do, to take a layered approach. That way, if you get a correction on this layer over here, you still have that layer over here in your savings account for a rainy day, basically, all right? So that's point number one. So take a defensive, layered approach to the stock market and stop worrying so much about it, you know? The comment was an interesting one in that they talked to me about, you know, everybody's talking. You know what I do when I hear too much talking? Shut it off. Go read a book. Go read an investment book. Remember why you did the plan or entered into the financial plan that you did. Readdress why you entered into that financial plan. Write it down so you know exactly what your goals are initially and know exactly what you're signing up for. Point number two, diversification, okay? This is something that I find is deficient in so many portfolios. Some people are overly diversified, so a lot of what I help do is to streamline and consolidate the layers, okay? I mean, I've helped folks, and I know you're out there watching, it's one of my devoted subscribers, you know, you end up owning, you know, 30 or 40 stocks spread out over maybe $5,000. That requires some consolidation. Other folks have multiple accounts with not a lot of meat inside those accounts, right? So we look to strengthen each one of those up. But diversification in its true nature is done through the ETF and index fund products. And when I talk about your option A, B, and C, I'm going to be offering up some of the very best ETF products and index products for you guys to go in there and look at. If you want to invest in a spider technology, you can do that. If you want to invest in an ETF that covers the utility sector, you can do that. If you want to invest in an emerging market ETF or an international company or a short-term bond exposure, you're going to be able to go in there and pick those products out of a hat, guys. Why? Because that's the era that we live in now. You should be able to explore your options, and by nature of exploring your options, you should be able to take your model portfolio based on your current attributes and pick out the resources within those particular baskets to fill that particular model portfolio for you guys, right? But diversification is the key. If we go into a correction in 2018, you are going to fall back on the strength of your diversification. You are going to fall back on the strength of how well you have built that portfolio. And I cannot overstate this enough. Way too many times I find that people they've bought 4 technology stocks and that's all they own, or they own technology and, you know, an industrial, right? And you forgot discretionary and staples, right? What was the outperformer this year? It was industrials. So if you didn't have any exposure to the industrial sector, you would have missed out. Look at what the energy sector has done latter 2017. If you didn't have any energy exposure, you would have missed out on some of that appreciation. So point number 2, to avoid any type of panic in the event of a downturn in 2018, you have to be diversified. The third aspect that I want to talk about for approaching the stock market in 2018 is your ability to tax protect and wealth preserve, okay? Remember the 60% buffer that you're playing with? Okay, I put you guys in the self-directed account for this reason and this reason alone. If you put AT&T within that account and it pays you a 5% dividend, you keep it all. You keep it all. If it appreciates 10%, you keep it all. If you put a Verizon in that, if you put a Walt Disney in there, if you put a Home Depot in there, if you put a Johnson & Johnson, a Procter & Gamble, all these quality assets that are all too often put into a retirement portfolio only to be subject to a managerial situation, they're going to suck you dry, all right? So knowing the type of account that you have and going with the self-directed method, You're a winner already. You are a winner when you get out of bed in the morning. You are already winning every single investment day that comes and goes. You are a winner. Why? Because all of the money is kept with you. You do not share it with anybody. You do not share it with me. You do not share it with your friend who's your financial planner. You do not share it with anybody. You keep all the rewards. And that, in and of itself, is a defensive mechanism against the downturn of the stock market. That's why when you go in to sit down with a financial planner, they will want to know if you have 10,000 or 50,000 or 100,000 of investment dollars to invest. They're going to want it all. They're not going to tell you that you should take $25,000 and put it away. They're going to tell you that any time is a great time to invest in the stock market. And when the stock market goes down, they're going to tell you to stay long on the stock market. Why? Because they do not have your best interest in mind. Their best interest lies with collecting as much assets under management under the particular financial flag that they fly. Does that make sense to you guys? Right? So there's no person that's going to have your financial best interest in mind and knowing and validating. And guys, I would feel like I won the lottery if I came across this information, man. I really would. And I feel that way about each and every one of my subscribers. If you guys have come across the channel for the first time and you're just now tuning in and you do not know what self-directed investing is, stay with my channel. Stay with my channel because the information is that critical. And the last thing I kind of want to talk about is how emotion has the ability to creep in to your investing decisions. I say it all the time, and it is in fact a cliche in that emotion has no place in investing, and it's so true. It's so true. It seems like the philosophical or the mental approach to investing for a lot of new investors is this right here. They want to invest in the stock market. Great. They'll pick a couple stocks out and they'll get invested and they'll be waiting and they'll be waiting and they'll be waiting until boom, that excuse comes along where they'll get a correction and they'll panic and they'll leave. That's the reactive piece and that's the emotional piece that you have to be able to drive out of your investment life. Investing is like autopilot, man. You have to be like a robot. And even though we are all human beings and we all do not like to see our accounts go down, it's fair to acknowledge that. But go back to my previous points and understand why we use a layered approach, why we diversify, why we go the self-directed method, right? Why we're paying ourselves first and understanding the value in investing on our own. Guys, thank you so much for tuning in to this edition of how to deal with the stock market in the eventual correction or sector rotation in 2018. I really hope you enjoyed this. Again, this was in response to one of my subscribers, Rolex, hit me up and wanted me to address this topic again because I do think it's extremely prudent and important for new investors to really understand. Stay the course, guys. Stay the course. Stick and stay and make it pay. Stick and stay and make it pay in the stock market, and it will indeed pay. If this is your first time tuning into the Independent Investor channel, I encourage you to subscribe to the channel. Leave your comments in the bottom. Hit the like button for me to support the channel, guys. Thank you so much for tuning in, and good luck in your investment future.